Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome to Tax Smarts Unlocked. I'm David Robson, family business tax strategist, and today we're diving into tax planning essentials for family-owned businesses, preserving wealth across generations. If taxes feel like a second job, you're in the right place. My goal is simple: show you how to minimize taxes today, optimize transfers tomorrow, and keep your family's legacy intact. We'll hit structures, payroll, real estate, retirement, estate tools, exits, and the checklists that keep it all compliant, with humor to keep it human. Let's start with entity choice. LLCs taxed as partnerships are flexible for allocations, basis, and bringing in the next generation. S corporations can reduce self-employment tax, but add reasonable compensation rules and shareholder limits. C corporations offer flat rates and potential QSBS benefits, but watch double taxation on dividends and exits. Think downstream. Will you gift interests, invite heirs as owners, or sell to outsiders? Your exit plan should drive the entity you pick today, the agreements you draft, and your accounting hygiene. S corporation owners often hear, "Pay yourself low, distribute the rest." That's half true and fully dangerous. The IRS expects reasonable compensation for services based on role, experience, industry, and comparable data. Start with what you'd pay a non-owner to do your job, document the analysis, and revisit annually. Distributions beyond salary generally avoid self-employment tax, but payroll taxes still apply to wages. Track officer time, job duties, and comparable offers as support. Compensation too low invites audits, too high sacrifices savings. Partnerships and LLCs shine with flexible allocations, but only if the tax capital and basis math is solid. Special allocations must have substantial economic effect. Document targeted capital or waterfall provisions. Guaranteed payments are deductible to the partnership and taxable to the recipient as ordinary income, but they can reduce 199A and increase self-employment tax. Basis equals contributions, plus your share of income and debt, minus losses and distributions. Lose track and you risk suspended losses and surprise gain on cash distributions. Employing family can be smart and legit. Pay real wages for real work at market rates, keep timesheets, and run payroll with withholdings. In a parent's sole proprietorship or a partnership owned solely by the parents, wages to children under 18 aren't subject to FICA or FUTA. Corporations don't get that break. The kiddie tax targets unearned income, not earned wages, so teens' pay is taxed at their brackets. Set job descriptions, issue W-2s, and open Roth IRAs when eligible. Income shifting must look like business, not charity. If your operating company pays a related management company or rents from a related real estate LLC, use written agreements, market rates, and consistent invoicing. Benchmark fees to industry data. Benchmark rent to comps and cap rates. Transfer pricing isn't just for multinationals. Family groups need arm's length support too. Separate bank accounts, timely payments, and 1099s help. When rates differ across family members or entities, cleanly documented shifting can lawfully lower the bill. Hold the operating business's building in a separate LLC for liability protection and clean books. Charge market rent and review annually. To accelerate deductions, consider cost segregation to identify shorter life components and evaluate Section 179 and bonus depreciation as allowed for the current year. Limits and phase-outs change, so confirm before filing. Real estate in a separate entity also simplifies gifting or bringing in heirs without disrupting operations. But coordinate leases, property taxes, maintenance responsibilities, and insurance, so there are no unpleasant surprises. Owner retirement plans can both defer tax and fund succession. Start with a solo 401k or 401k with profit sharing to maximize employee plus employer contributions within annual limits. For higher earners, layer a cash balance plan for defined benefit style deductions, coordinated with your 401k to avoid testing issues. Plans must cover eligible employees, so model costs. These vehicles can equalize compensation among active family members and help buy out retiring owners via after-tax cash flow, relieved by pre-tax contributions. Health benefits are powerful when structured correctly. Small employers may use QC-RAs. More flexible setups can look at ECRAs. Traditional group plans remain solid, and all pair well with Section 105 and accountable plans for tax-free reimbursements. More than 2% S corporation shareholders include health premiums in Box 1 wages, then take an above-the-line deduction. FICA does not apply. Reimburse only substantiated expenses, set written policies, and audit reimbursements like the IRS would. Qualified business income can reduce your pass-through tax by up to 20%, but the calculation is tricky. Optimize W-2 wages and qualified property to support the deduction when income exceeds thresholds. Consider aggregation elections for commonly owned entities with interdependencies. Beware specified service trade or business limits for fields like health, law, and consulting. Remember, reasonable S corporation wages don't count as QBI, but profit does. Track REIT-PTP components and document your position annually. One missed election or misclassification can erase savings. Material participation separates passive from non-passive outcomes. Passivity can trigger the 3.8% net investment income tax and limit losses. Use the 7 tests. Most family owners clear the 500-hour or substantially all test. Group related activities and keep time logs. File formal grouping elections. Rental to a related operating business may be non-passive if properly grouped. Watch S corporation owners serving through partnerships. Self-employment tax can sneak in. Design roles intentionally and document involvement. State and local taxes can ambush multi-state families. Track where you have payroll, property, and sales. That's Nexus. Apportion income correctly and register for sales and use tax where required. Many states now offer pass-through entity tax elections to bypass federal SALT limits by shifting deductions to the entity. Deadlines vary and can be early. Missouri offers a PTET option. Confirm current eligibility, rates, and due dates before year-end. Map your state footprint annually and coordinate filings across all entities. Estate and gift planning connects today's profits to tomorrow's legacy. Use annual exclusion gifts and lifetime exemptions. Amounts may drop after 2025. Transfer business interests, not cash, to leverage valuation discounts. Pair gifts with grantor trusts, like IDGTs, or GRATs to freeze growth outside the estate. Use family-limited partnerships or LLCs to create voting and non-voting classes for control. Plan basis step up at death. Mind community versus separate property rules and avoid structures that forfeit step up. A buy-sell is your family constitution for ownership changes. Define triggers, death, disability, divorce, departure, and valuation methods with an appraisal process. Fund obligations with life and disability insurance so heirs and the business survive. Governance matters. Outline boards, advisors, and dispute resolution. Separate voting from economics with non-voting interests. And set compensation, distributions, and performance metrics for active versus passive heirs. Hold family meetings to teach financials, celebrate wins, and keep expectations aligned before conflict starts. When selling, asset sales usually yield higher purchase prices but can create ordinary income, recapture, and state taxes. Stock sales may secure capital gains and cleaner exits. Consider installment sales and earnouts to spread tax but model interest and risk. If you converted from C to S, beware built-in gains during the recognition period. For growth companies, C corporations can unlock Section 1202 QSBS exclusions after a 5-year hold if eligibility is met. Trade-offs include double tax on distributions. Charitable planning can round out succession. Fund a donor-advised fund in a high-income year using appreciated securities or interests to capture a fair market value deduction and avoid capital gain. For income smoothing, charitable remainder trusts can provide payouts to family while deferring recognition. Charitable lead trusts can advance philanthropy while passing growth to heirs. Ensure business interests are transferable and the charity or DAF will accept them. Align philanthropy with governance so rising generations see purpose alongside profit. Documentation is your shield. Keep contemporaneous minutes, written leases, intercompany agreements, payroll records, time logs, appraisals for transfers, and valuation memos for 199A and reasonable comp. Reconcile books monthly. Each year, check changing depreciation rules, retirement plan limits, estate exemptions, PTET windows, and election deadlines. Update buy-sell formulas and insurance. When complexity stacks, multiple entities, multi-state operations, or looming exits, assemble a team: CPA, tax attorney, valuation expert, and financial advisor. Coordination avoids whiplash between good ideas and bad outcomes. Case Study 1. A sole proprietor landscaper formed an S corporation. We set a defensible $78,000 salary via regional data. Profits above that flowed as distributions. His 2 teens handled social media and shop cleanup with timesheets and W-2s. Once incorporated, payroll taxes applied. We put the shop in a separate LLC, signed a market lease, and used cost segregation to accelerate depreciation. Case study 2. A manufacturing LLC created non-voting units, then gifted interest annually using valuation discounts. A buy-sell funded with insurance and a cash balance plan accelerated the founder's retirement. That's a wrap. Today we covered entity choice, compensation, allocations, family payroll, real estate, benefits, QBI, state traps, estate tools, succession, exits, QSBS, charity, and compliance. Use checklists, document well, review, and coordinate advisors. Taxes shouldn't drain your legacy. They should help preserve it smartly.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services. Each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.